It does take us to our talk of the tape. Slow down or melt up? That is the question following the Fed's first rate cut in years. Let's ask Dan Greenhaus, Solus Alternative Asset Management's chief strategist, with me here at Post 9. Was this, good to see you.
Good to see you. Welcome back.
Game changer? The fact that it was 50?
I don't think it was a game changer per se. I know there was a debate on the halftime show about whether it was a surprise or not. I think most people in my seat who look at things from a macro standpoint were probably caught off guard. And that's because going into the quiet period, we'd all expected 25 basis points. And then the Federal Reserve has now decided to alter how we think about things, which is to say now during the quiet period, you can change market expectations by leaking to newspapers, something that up until this point we really haven't had to deal with very much.
50 was the right number, according to Waller, who was with Leisman exclusively earlier today. Was the right number. As Chair Powell said, we're at a point where the economy is strong, inflation's coming down, and we want to keep it that way. So we felt 50 was the right policy action to do. So if they're cutting while the economy's still strong, it's a bit of an insurance cut. What does that mean for stocks then going forward?
Well, just to start with, when we last spoke, when you were out west, one of the arguments I made is that I could easily make the case for 25 basis points, which was my assumed outcome. I could easily make the case for 50 basis points. And I think the case that Jay Powell made was the case that all of us who said, well, if you had to cut 50, this is the case you would make. That's the case Jay Powell made. The economy's still doing well, but I implore everybody who's watching at home and for the discussions we have on the network, this isn't about the economy weakening in any meaningful way. There's obviously some weakness in the labor market. It's about the Fed just getting back on sides with where real rates and nominal rates should be, considering what the progress they've made on the year-over-year inflation rate. It's really not much more complicated than that.
Okay, so then why is it any more complicated than don't fight the Fed?
Oh, well, listen, I'll repeat a long-held position of mine on the show, going back to September 23, when the Federal Reserve introduced for the first time their 2026 estimates. That was the first time that they said that inflation was not going to get back to target until 2026. So what the Fed said then, again, this was back in late 23, we're not willing to do what everyone else tells us is necessary in order to bring the unemployment rate back to target and the inflation rate back to target more quickly. We're not willing to do that. We're going to wait until 2026 for inflation to normalize. That, to me, was and remains an incredibly bullish development. The Fed's saying, I'm not going to crack this. I know people keep telling me they want us to crack it, but I'm not going to. So to answer your question, what does it mean for risk assets? For investors at home, this is really very simple. The economy continues to do well. Obviously, it's decelerating to some degree, although from an elevated level in the back half of last year. Interest rates are beginning to come down, the 2-year and the 10-year both. The yield curve is now steepening. The dollar has sold off a bit. All of this is, all else equal, generally speaking, risk asset positive.
Which is why Brian Belsky raised his price target.
That's right.
He said to 6,100.
That's right. And
assuming that earnings are going to hold up and deliver the kind of results that he expects they will, justifying the multiple that he thinks is deserved.
To state the obvious, if earnings don't hold up, if the economy does turn down, then 6,100 is not going to happen.
Well, you think 24.5 times or whatever the market's trading at is realistic?
I don't love the infatuation with the multiple. Listen, the multiple tells me a lot about market expectations and risk tolerance, et cetera, but at the end of the day, it's never been and never will be, never has been a market timing tool. The same people who are saying that the market is expensive at 21, 22 times are the people who are telling the people at home that the stock market was expensive at 17, 18, 19 times. The market is rich to its history. Now, again, a lot of that has to do not with some broad-based overvaluation, but with the weight that's conveyed upon the market by NVIDIA, by Apple, et cetera, all of which trade with higher growth profiles, so they trade at higher multiples. But I don't love the idea that, well, stocks can't go up, which is the insinuation, because they're at 22 times forward or whatever. They can certainly go up. They were expensive. The first time the idea of a stock market bubble started percolating in the mid-1990s was 1995. The irrational exuberance speech famously is 1996. And equities continue to go on and make new highs for years. So telling me equities are overvalued doesn't really do much for me over the next 6 or 12 months.
Okay, so